Hello class, my name is Mike Nolan and this is my week 6 multimedia presentation on taxation. So first I'd like to begin with an overview. In this presentation we're going to talk about the historical context of taxation, types of taxes, the economic efficiency of those taxes, and distortion effects of taxes. So the collection of taxes goes all the way back to biblical times and is also reinforced in our Constitution. The 16th Amendment to the United States Constitution addresses taxes and that Congress shall pass to lay and collect taxes on incomes from which source is derived without the appointment among the several states and without regard to any census or enumeration. In addition to the 16th Amendment to the Constitution, Article 1 in Section 2, Clause 3 of the Constitution, and there's also several others to include within Article 1, Sections 8 and 9, both cover the collection of taxes. In addition to the biblical reference and the constitutional reference as taxes, I find the simplicity in looking at taxes as they relate to government as a business. For any business to remain in existence, the business must have fiscal solvency to continue its operations and meet the demands of the consumer or the end user. Well, much like a business, the government must generate and maintain sufficient sources of revenue capable of funding the operations of the government. And for me, this is where taxes come in. So property tax is the first of the three taxes that we're going to be discussing today. For most local governments, property tax is a principal source of their revenue. Property tax is a tax that's imposed on real estate or personal property. The values of the property tax is determined by local officials. However, it can sometimes, in some cases, be disputed by the property owners. There are some advantages and disadvantages to property tax. A disadvantage to the taxpayer is that the tax liability is fixed, while your income as a taxpayer may not be fixed. While this may be a disadvantage to the tax-paying member, there is an advantage to the taxing authority, and one of the advantages with property taxes over sales tax or income tax is that the revenue is always equal to the tax levy, which is unlike sales tax or income tax. According to the U.S. Department of the Treasury, there are three types of sales taxes: vendor tax, consumer tax, and vendor consumer tax, a combination of the two. A sales tax is a tax that's levied on a good or a service. Very often we pay sales tax when we're purchasing an item or paying for a service, such as window cleaning service for our business or our home. A vendor tax is a tax that's placed on the person who's actually doing the business. For example, if I owned a hamburger stand, I would be taxed in my state or my local municipality for the right to sell hamburgers in that area. The amount of tax that I paid would be based on the amount of sales of hamburgers that I would make for my business. A consumer tax is a tax on the retail sale of that item. For example, if I bought a record album at a record store, I would be required to pay an additional tax on that item for the record that I'm purchasing from that store. A vendor consumer tax, a combination vendor consumer system, taxes the vendor, who then taxes the person who's purchasing the item. From our standpoint as a consumer, we don't necessarily see the difference, but we're paying the additional tax, and then a portion of that tax the vendor is sending and paying their vendor tax on it. Of all the taxes we discussed in sales tax, they are all a regressive tax. All people, no matter how much we make or earn, we pay the same percentage of tax on sales tax. And this is why it's called the regressive tax, because people with smaller incomes pay a larger percentage of their actual money into the sales tax system than people with higher incomes. At one point during our nation's history, sales tax had such an effect on the consumer that during the Great Depression, they devised these consumer tax coins that you see here up in the top right. This is Consumer Tax Check, Oklahoma. And these coins or tokens were used when the tax was marginal. If they were buying an item that was 10 cents and the tax was not a whole penny, these were used as half-cent markers in order to pay the tax but not overpay on the tax, because the importance and scarcity of money at the time during the Great Depression, people were concerned in overpaying their taxes, and that's how these half or marginal cent coins came into use. When we discuss income taxes refers to the annual taxes levied by the federal government and most states on individuals and businesses and their income. By law, businesses and individuals must file their state and federal income tax returns every year to determine whether or not they owe taxes. Income tax is applied to both earned income, which is your wages, salaries, and commissions, and unearned income, which would be referred to as dividends, interest, and rents. Income tax is considered a progressive tax in which higher income earners pay a higher tax rate compared to their lower earning counterparts. The intent of this progressive tax system is to distribute wealth more evenly across a population by taxing those who make more, and by taxing those who make less, less. The concept of economic efficiency is that the tax system should not interfere with the efficient allocation of resources. Economic efficiency relates to the significance a tax has on the allocation of that resource. Essentially, the tax should not create a dramatic shift in the sector it's governing. It's important to recognize that all taxes affect behavior. Distortions are associated with these actions that individuals take to avoid taxes. Examples of distortions are working less reduces your tax liability. I know that many a times I've avoided the opportunity for that extra day of overtime because I know the more hours that I put in, the more I'm going to be taxed on it. And at some point it becomes where it's not necessarily a break even for the amount that I'm working and the amount that I'm going to get taxed in the end. So I'll avoid the extra hours of work to avoid the taxes. The main way that taxes harm our economy is just that, it's causing people to change their behavior. Examples of this are raising the income tax. People will work less, just in the case that I illustrated with myself. Higher sales tax can make people spend less. And the only way to avoid property tax increases is to sell your property, and then even then you have to find a buyer who's willing to take on the tax burden you're giving up. While real property is subject to some distortion, I still feel that real property is the best tax base from a government standpoint, because once that property is built, it typically lasts for a long time, and especially in the case of the land will be there forever, and the structure may not. However, we as economic actors can't necessarily respond to a higher tax on land by reducing the amount of land that actually exists. We may change where we choose to build that land or move our home or our company out of a certain tax base, but also in rare cases, taxes can get so high that they just encourage people to all out abandon their property, as we saw in some cases in the depression that Detroit suffered. Well, I know I went a little over there, so I apologize in advance, and thanks for watching, and here are my references.